The government doesn't advertise this either. It's like a secret tax trap waiting for you to catch you off guard. But here is the good news. There are 7 completely legal ways to avoid this tax trap. And I'm not talking about complex tax schemes or anything dodgy. These are straightforward strategies that anyone can use. Let me show you the most powerful weapon against £100,000 tax trap. Do you think the highest UK tax rate is 45%? Think again. The government has a hidden 60% tax trap waiting for you at £100,000 and most people have no idea it's there. I learned this the hard way when I saw my paycheck shrink despite my salary going up, and I don't want you to make the same mistake. But here is the thing, I am not going to give you a complex tax theory. Instead, I am going to show you 7 proven strategies to legally avoid this trap. I discovered this the hard way when my NHS consultant salary crossed £100,000, but these solutions work for anyone over £100,000, whether you are in tech, finance, business, or even healthcare. What's really shocking is that for every £1 you earn between £100,000 and £125,000, you could be keeping only 40p with you. But there is a way to fix this. Hello, I am Dr. Suman and I share practical financial strategies that actually work. When I discovered this tax trap, I spent months researching every legal way to avoid it. What makes this video different is that complete transparency, real numbers, real strategies, and real solutions that anyone in this income group can use. I will use my NHS salary as an example, but whether you are a business owner, corporate executive, or a salaried professional, these strategies work exactly the same way. The key is understanding how to implement them correctly. This video is not financial advice and I am not a qualified financial advisor. So please get professional advice from a qualified financial advisor if you need help. In this video, you will find out why earning £125,000 and £140 can leave you marginally better off than £100,000. You will also learn about the different strategies to protect your income and exactly how I'm implementing these strategies for my tax savings. Before we dive into these strategies, let me quickly break down how tax actually works in the UK. Because trust me, this is crucial to understand why the £100,000 mark is such a big deal. Here is how tax works for current financial year, that is 2024 and 2025. First, everyone gets a tax-free amount which is £12,570, and for this you don't pay any tax. This is your personal allowance. Think of it as your tax-free pocket money. But here is where it gets interesting. Then it goes like this: £12,571 to £50,270. For this you pay 20% tax. This is what most people pay in the UK. Pretty straightforward, right? Next level is £50,271 to £125,140. For this you pay 40% tax. This is where things starts getting expensive. But wait till you see what happens after £100,000. We also have the additional rate tax band, which is over £125,140. At this range, you pay 45% tax. The highest official tax rate, but it's not actually the highest rate you can pay because there is a hidden tax trap over £100,000. And here is where it gets crazy. At £100,000, our personal allowance starts tapering off. You lose £1 for every £2 earned over £100,000. It creates an effective tax rate of 60%. By £125,000 and £140, this personal allowance is completely gone. And that's why we need to talk about these strategies. Let me show you something that will blow your mind. If you earn £100,000, you take home £5,713 a month. But if you earn £125,000, you only get £654 more. That's right, extra £25,000 means only £654 in your account. Let me tell you what happened to my friend Anand. He is a software engineer who was thrilled when he got headhunted by a big tech company in London. His salary jumped from 98,000 to 115,000, a massive £17,000 increase annually. Dream come true, right? Not really. Over 2 months into his new job, he called me completely frustrated. Something's wrong with my payslip, he said. Despite that huge salary bump, his monthly take-home pay had only increased by £450. Even worse, he discovered that his lost tax-free childcare benefit worth £2,000 a year for his 2 young kids. And here is the real kicker. He was no longer eligible for 30 hours free childcare for his younger child, which meant paying an extra £8,000 annually for his childcare. Now do the math. That amazing £17,000 pay rise actually left him worse off by several £1,000s a year. His story isn't unique. This is happening to thousands of professionals across the UK who cross that £100,000 threshold of annual income. Here is what's actually happening. At £100,000, something really sneaky kicks in. Let's break this down with a simple example. Say you earn £100,000 and get a £1,000 bonus or maybe an extra income. First, you pay 40% tax on that £1,000. That's £400 gone. But here is the sneaky part. For every £2 you earn over £100,000, you lose £1 of your tax-free personal tax allowance. So that £1,000 bonus means you lose 500 of your personal allowance. That £500 gets taxed at 40% too. So another £200 gone. Total tax on your £1,000 bonus or extra income becomes £600. That's right, you are effectively paying 60% tax, and nobody tells you about this when you get that promotion or pay rise. The government doesn't advertise this either. It's like a secret tax trap waiting for you, catch you off guard. But here is the good news. There are 7 completely legal ways to avoid this tax trap. And I'm not talking about complex tax schemes or anything dodgy. These are straightforward strategies that anyone can use. In fact, the government actually encourages you to use this strategy. Before I show you these strategies, let me ask you this. If you could keep an extra £15,000 this year without working any harder, would you want to know how? If yes, then keep watching this video. Let me show you the most powerful weapon against £100,000 tax trap, your workplace pension. And trust me, this is like finding money you didn't know you had. Let me share what happened with my NHS pension. When I first became a consultant, my base salary was £105,504 per year, over the threshold by £5,504, facing that nasty 60% tax rate. And I was about to lose my personal tax allowance as well. But here is where it gets interesting. Your workplace pension, whether it's the NHS or the private sector, is absolutely incredible for tax planning. Here is why. Let's say you are earning £110,000 per year. Now you put 10,000 into your pension. Watch what happens. Your taxable income drops to £100,000 and remain in the 40% tax slab. You keep your full personal allowance. You save on national insurance. Your employer might add some extra contributions, and the money goes tax-free and you get a bigger pension pot. On the other hand, without pension planning, your taxable income will remain £110,000. You pay effective tax rate of up to 60% on some of your earnings. You lose your personal allowance. You also have to pay higher national insurance, and your take home as a result will be much less than £100,000 income salary. Now, if you are part of the NHS pension scheme like me, it gets even better. It is a defined benefit scheme and you get guaranteed income after you retire. Here, the employer contributes significantly to your pension pot. You also have other benefits like death in service benefit, built-in life insurance, and inflation protection after retirement. But here is something most people miss. You can actually increase your NHS pension contribution through something called additional voluntary contributions. But there are some things that you need to watch out for. Number one is the annual allowance, which is currently £60,000. You also need to bear in mind about your lifetime allowance considerations. There is something called tapered annual allowance for high earners, and this might also impact your cash flow. For pension, one of the problems is that you can't access your money before your retirement age, which is currently 67 years but will likely become 68 years when we retire. The best part, this is probably the safest tax saving strategy out there. It's government approved, well regulated, and comes with built-in protections. You will need a qualified financial advisor if you want to clarify about your pension benefits. So please do consult qualified financial advisor to help you clarify your doubts. You may check out unbiased.co.uk. You will find the link below in the description to search for a qualified financial advisor who can advise you about your tax matters. Remember, this isn't about saving tax. It's about building your future wealth too. You are essentially turning a tax problem into a retirement solution. The second strategy is about gifting or doing charitable donations. This one's clever. Let's say you are already donating to charity. You are probably missing out a huge tax benefit. Here is why. When you donate £800 through gift aid, the charity will get £1,000. But here is the magic. It reduces your adjusted income for tax purposes also. You can even carry it back to previous tax years if you need to fix a tax issue from the last year. For this, you will need a qualified accountant. So please do find a qualified accountant who can advise you about these matters. The third strategy is about EIS or SEIS scheme. Now let me share something really interesting. The EIS or SEIS investment strategy. This is like the secret weapon of tax planning that most people never hear about. But it comes with both massive benefits and serious risk about losing your money. Let me break this down for you. First, let's talk about the EIS or enterprise investment scheme. Imagine investing £50,000 in a promising startup. Here is what happens. HMRC immediately gives you £15,000 back in tax relief. If the company succeeds and you sell your shares after 3 years, you pay zero capital gains tax. If the company fails, and let's be honest, many startups fail, you can offset the loss against your income tax. You can even invest up to 1 million per tax year in this scheme. Now coming to the SEIS or SID enterprise investment scheme, which is even better. Here you get 50% tax relief instead of 30%. Let's say you invest £100,000, you will get £50,000 tax back from HMRC. Same zero capital gains tax benefit also stays here. Sounds amazing, right? But here is where I need to be completely honest with you. These startup investments are seriously risky. Let me share an example of one of my friend Tom, who invested £40,000 in what seemed like a promising tech startup through the EIS scheme. He got £12,000 back in tax relief immediately. The company looked great for first 2 years. Then something happened and it could not secure additional funding and the company failed, losing the remaining £28,000 for Tom. Yes, he could offset that loss against his income, but it was still a significant loss. Here is what you should absolutely know before investing in EIS or SEIS scheme. These are usually very early stage companies. Most startups fail, and that's just the reality. Your money is locked for at least 3 to 5 years. There is no way to sell your shares early. You need to do serious due diligence before you consider investing in these schemes. If you want to invest in either of the schemes, then please invest what you can afford to lose and diversify across multiple companies. This video again is not financial advice, so please do your own research before you invest your own money. If in doubt, then please do use professional advice to make sure whether this kind of investment is right for you, and consider this as a part of a broader tax saving strategy. Remember, this isn't like putting your money in a savings account or buying shares in a big company. This is venture capital territory. High risk, potentially high reward, but with some amazing tax saving benefits. To soften the blow if things go wrong, strategy number 4 is to claim back your employment expenses. You'll be amazed how many people leave money on the table here. Just last week, I was talking to a senior doctor who didn't know how to claim professional subscriptions, for example, the GMC as well as the medical indemnity payments. Doctors can also claim about the membership that we have for Royal Colleges and certain exam expenses. There are allowances for home office equipment for people who work from home. Also, some travel expenses can also be claimed as a part of professional expenses. So please don't forget to claim all these professional expenses to help save your taxes. Next, let me show you one of the smartest tax strategies if you are married or in a civil partnership. This one's like finding free money, but most couples don't use it properly. If you are married or in a civil partnership, this strategy is gold. Here is how to use this. Couples can split their income generating assets to reduce the tax burden. They can also share dividend income. Please make sure that you use both your ISA allowance, that is £20,000 each. So for a couple, it's £40,000 in a year. You can also balance income between two partners and transfer assets strategically. For this, again, you need a qualified accountant to help you and advise you about the schemes. Strategy number 6 is high income child benefit charge and how you can use this to save your taxes. Let me show you something that's costing parents thousands of pounds every year. It's about child benefit, and trust me, this is going to surprise you. Here is what most high earners do. As soon as the income of a parent hits £60,000 salary threshold, they will have to pay high income child benefit charge. They stop claiming child benefit completely because they think that they are doing the right thing, but they are losing big time. And here is what nobody will tell you. Child benefit claims give you national insurance credit. This counts towards your state pension when you retire. Each year missed equal to lower pension. By this, you could lose thousands in retirement. So the smart strategy is what you should do. Always register for this child benefit claims, even if you don't claim any money because you are earning more than £60,000. Here is what you should do instead. You don't need to actually claim any money. It just keeps your national insurance credits going and protects your state pension. Strategy number 7 is salary sacrifice schemes. Now let me show you one of my favorite tax saving strategies that most people completely miss: salary sacrifice schemes. And the best part, you get something awesome while saving tax. Let's say you are earning £110,000 in a year. You are in that nasty 60% tax trap. But watch what happens when you combine different salary sacrifice options. You can use the electric car schemes as a part of this salary sacrifice scheme. This is the biggest win right now. Sacrifice between £500 to £800 monthly. Now this is an example for a brand new electric car. That's £6,000 to £8,000 per year of your income. Usually through this scheme, the insurance and the maintenance of the car is completely covered. You also have massive national insurance savings and you get a brand new electric car. You also have salary sacrifice scheme for other stuff except a car. For example, cycle to work scheme where you can get up to £3,000 for bikes and equipment. It is perfect for commuting if you live close to your workplace, and also it has some health benefit as well. Another example of salary sacrifice is technology schemes, and you can buy latest phones, tablets, computers, etc. usually between £2,000 to £3,000 limit, and you can spread the cost over 12 to 36 months. This is a good one for upgrading your phone and also for home office setup. Sometimes salary sacrifice scheme also gives you gym or some health club memberships. Here is an important warning for this kind of schemes. Always watch out for the contract length commitments, early termination fees, impact on mortgage applications, and effect on other salary linked benefits. For example, the maternity pay. Remember, this isn't just about tax saving. You are getting valuable benefits while reducing your taxable income. This is perfect for avoiding the £100,000 tax trap while upgrading your lifestyle. Now, let me share something personal. When I first hit the £100,000 salary mark as an NHS consultant, I was shocked about how much tax I was paying. But using these strategies, I have managed to keep more of my hard-earned money while building the future. And make sure you are not losing money that you should be keeping. Please do hit the subscribe button and like and share this video with your friends. This is Dr. Suman, helping you build your wealth one step at a time. See you in the next video.